and welcome to the latest market update with me, Andrew Dawkins from A.R.D. Consultancy. So October was a month for profits again after last month's negative returns. So we've had a positive growth over all the portfolios that we've run. Outstanding contributions from the US in terms of the fund that we're using there, up over 3% for the month. There's been some good reporting figures from many of the big companies in the US. Quantitative easing is still continuing. The jobs market has improved significantly, and there's a general shortage of labour and supply chain issues as the demand outstrips supply. The quantitative easing continues by the Federal Reserve, and inflation is still continued to be somewhat of a blip, although perhaps we may have different views on that. So the US is showing good signs of growth, is one of the top performing sectors over most investment time periods, and we're expecting good things of it as Biden's hopeful infrastructure bill nears completion and more money gets released into the market for that. Turning to the UK, and the UK larger company portfolio saw positive growth for this month, and there were good numbers coming out of companies reporting during this period. Demand remains very, very strong. The Bank of England has signalled that rates are likely to increase, probably sooner than many people would have forecast. And this is a result of the way that the economy has expanded significantly over the last few months. So it's one of those things that's it's a good news on one side that prices are increasing because it shows there's excess demand, and on the other side it's perhaps not so good for those companies or individuals that are looking to take out debt, as the cost of that may become slightly more expensive. But for many of our assets it's good news because it simply shows that some supply and demand is being outstripped. Turning to Europe, and our European funds up almost 2% over the month. The European Central Bank continues to be fairly relaxed about inflation and is continuing to put vast sums of money into the money markets, and this is fueling cheap money, which then is designed to increase consumer expenditure and also expenditure in development of research by companies that are taking out debt. The inflationary pressures are starting to build, however, and in Europe they have the same issues as many other parts of the world in terms of the lack of capacity in some of the job sectors, noticeably in delivery and supply chain. Europe is home to many of the world's great companies, and the funds itself hold some really good assets, and we expect growth to continue in those sectors, especially with the effects of COVID now being lessened. Turning to global real estate, and our global property fund has delivered over 3% profit this month, which is a real good contributor to the portfolio's success. There's demand for quality property all over the world, and not really seeing much of a negative impact of COVID in terms of workers perhaps remaining at home and office space being underutilized. It seems to be just the opposite. Some noticeable expansions and demand, especially in the key locations, which have been priced in accordingly. So the property market looking very, very good worldwide, and probably a good decision to move to global as opposed to keep the property portfolio in the UK. A surprise in terms of the fixed interest world, which has been in the doldrums for a good number of months, as you'll all be aware. This month we have the UK government gilt fund increasing by over 4%, which makes it the best performer of the month of October. So this really follows the fact that the Bank of England are talking about increasing interest rates, which has therefore meant that gilt yields will probably rise. On the back of this, the value of our account also rises. So longer term, inflation will be up there. The latest estimates are indicating perhaps inflation could reach 5% and stay at that level for a lot of the next year or so. and this will lead to the Bank of England being forced perhaps to increase interest rates even further. When we talk about the increase in interest rates, we're not talking about 1 or 2 percentage points, the bad old days of the 80s and 90s, but by 0.15 of 1%. So it shouldn't really cause any major issues. And again, it reflects the fact that the economy is doing very, very well, because we're only increasing interest rates to try and cool down an economy that's growing quite quickly. So the UK economy doing very, very well. And if we look at it, the Ftse 100 index is actually yielding at the moment a dividend of just over 4%. And this makes it the highest producing dividend index of the developed countries. So a very impressive return from many of the UK companies. Turning to the Far East, and our Far East performance is a negative return for this month, a negative 1.3%. And there's many reasons for this. We've got the Evergrande debacle over in China, which is casting a bit of a shadow of the rest of the Far East in terms of property developers, with the potential there that you're going to default and then later bankruptcy, a major player in the property market there. We've also got the effects of COVID is still continuing to push demand. And we've also got rising fuel prices, and this is concerning because of the fact that then it's going to put pressure on inflation. Japan is continue to relax its monetary policy, pumping vast sums of money into the Japanese economy, making it one of the most indebted nations on the face of the planet. But it doesn't seem to cause any issue for the Japan government and the population there, who seem to be happy to accept negative interest rates over there for the time being. Rest of the Asian world is doing not too bad, actually, and there's good consumer demand, but we're faced with a challenge, just like the rest of the world, that there's bottlenecks in terms of ports and in terms of getting goods from the producers into the hands of the consumers. So we'd expect that the Asia region, being so huge, is probably going to do very, very well over the next year or two. And the returns that we currently see, the volatility, is all part and parcel of the wonderful world of investing. So overall, October was a good month for us, with many of the equity funds showing positive returns. Negative returns still on the fixed interest corporate bond side, to be expected. And property came in with a good performance for us this month. And UK debt was the star of the show for once. We'd recommend people to keep an eye on their portfolios, the risk levels, and look for updates. And we're always keen to have conversations surrounding the funds that we use and our views on the progression of the investments in general. And finally, for the portfolio numbers, the defensive account has grown by 0.2% this month, over a year by 6%, over 5 years by 26%, and over 10 years by 79%. The cautious portfolio this month is up 0.3 of 1%, over a year 11% growth, 5 years 36%, and over 10 years 108%. The balanced portfolio this month up 0.3 of 1%, over 1 year up 17%, 5 years 51%, and 10 years 147%. Turning to the capital growth portfolio, this month up 0.4 of 1%, over the year 23%, over 5 years 66%, and over 10 years 197%. And finally, the aggressive portfolio, this month up 0.4 of 1%, over 1 year up 28%, over 5 years an impressive 81%, and even better over 10 years 263%.